My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today we got an old friend back on the show. Reed Goossens has been in real estate for quite some time. As soon as he starts talking, you'll realize he's not from these parts originally. He comes from Australia, but he's made a very good, successful career as an American real estate entrepreneur. And today we're going to talk about kind of the changes, the pivots he's been making with his company, as a lot of folks have over the last couple of years, because multifamily has become much, much more challenging. So Reed, welcome to the show again. Good to see you, my friend.
Dave, great to be back, mate. Thanks for having me.
So Reed, give us the quick version of your backstory, because it's fascinating.
Quick version, met a girl backpacking in 2009. I was working on the super yachts in the south of France, think below deck, but before it was popular. Fell in love. She came to Australia for a bit, and in 2012, we moved to the US. Didn't have a job, rocked up, door knocked, got a visa, I'm a structural engineer by trade. And then within 6 months, started to realize how cheap property was in the US, particularly in tertiary markets. Bought my first $38,000 triplex. 14 years later, a bit longer than that now. 14 years later, I was the founder of another company through two syndication platforms. I've done nearly $1 billion in transactions. We've sold 7 assets. I've done 30 in total. We've raised a lot of money, had a very good run post 2012 with the Jobs Act changing. And then it all sort of went to hell in a handbasket, right? Which we can talk about, and we've learned, and we're pivoting, and we're doing all the things, but we're still here, we're still surviving, we're still closing on deals, and we're still very bullish on the multifamily market. It's just having as an operator, changing the way we think. So that's a bit of the backstory, and it's been an awesome journey so far.
Yeah, ups and downs and all arounds, and that's for sure. And if you can survive the downs, then you come out the other side much, much smarter, stronger, more resilient. So yeah, let's talk a little bit about that. But then I want to jump into what you're up to now, because you've got an interesting, I think you call it an additional stool to your business that I want to dig into there. But first things first, tell me a little bit about the current portfolio, kind of the challenges you've seen over the last couple of years, and what you guys have learned or doing differently now with multifamily.
Sure. Look, so I mentioned Jobs Act earlier. Luck has got a large part to do with a lot of entrepreneurs' journey. That helps you get started. I moved here in 2012. The Jobs Act changed. You saw a lot of people starting to raise money in the retail space. I've been a beneficiary of that, and we grew, right? A lot of non-institutional investment came into the diversified alternative real estate class, investment class of real estate, particularly commercial real estate, and we saw a big run up, and I've been a beneficiary of that. And then we saw COVID hit. That changed completely the way in which we operate. A very an old way of thinking how real estate was, very mano a mano. A lot of tech came in, right? We started to have to lease online, and that changed the way. Then we had a lot of money in the in circulation that pushed up pricing. Interest rates were down, then boom, it flipped on a head. That changed. Stimulus money cut off. Supply was too much, and we find ourselves in a very similar times. And I wasn't around in the 70s, but oversupply, high inflation, low rent growth. And it's the first time the syndication world has gone through its first recession, right? And that's what we're in right now. Now, this is not immune just to the retail syndicator. It's, big institutional groups have also made, bets and have not come out to fruition. But we as a company have been continuing to do deals over the last 3 or 4 years. And if we call the peak with 2022, we've been able to do deals all the way through that and pick up some really great deals. But the retail side, the investor side has been difficult to raise from, where historically, probably like yourself, you could raise 10, 15, $20 million really quite easily over a short period of time. Today, in getting deals done, We're structuring with ticks. We're having pref in those deals. We're having to
for folks that aren't familiar, what are ticks? What is
ticks? Tenant in commons, 1031 exchange investors rolling their money in. We're having preferred investment groups come in and just getting to the closing table and then continuing to raise post closing because we can't raise all the money. Where there was a time where you had to turn away people.
Right.
So
right.
It's really flipped on its head in terms of the business in itself. And there's a lot less people in the space today, and unfortunately, there's blood in the street, right?
Yeah,
it's the reality. People are handing back keys, investors are getting whacked, and those same investors that we're going to are saying, "Hey, sorry, you got whacked, but trust me, it's a good time to be buying," and it is a good time to be buying, right? The beauty about real estate is that you can see the cycles changing. It doesn't happen like the stock market overnight, and it just crashes, right? We're not like that. It's a bit of a slow moving machine. So you can see when things happen. And we've been now in a rate cutting environment for a period of time now. Cap rates are starting to compress again. The big thing that we're trying to really get our head wrapped around is the absorption piece in the Sun Belts, the Phoenixes, the Austins, the Atlantas, the Charlottes, the Orlandos. Like, when is that easing up? And when there's a lot of talk around starts dropping off a cliff and yada, yada, yada. And we're still very big bullish believers of affordable housing and remain so. And we've built out a niche and we're relatively good operators. But we need to see we're only as good as what the rental growth will perform in a local market, right? So I can't push rent if rent's not there to be pushed, right? It's like pushing a rope up a hill. You can't do it. So you've got to focus on operations. You've got to focus on tenant retention. And then add on top of that, we've had some immigration stuff. Not getting political, but that has impacted, our workforce housing, right? So there's been a few punches to the kidney post-COVID that we've had to deal with, right? And it will end. It will end, and we will ride this out, and it will be fine. But it has meant that from a business perspective, you can't be reliant upon doing deals all the time when the deals aren't there to be done. And that's the cold shower that we've all had to face as operators.
So I've interviewed a few folks talking about similar things, Reed, and a lot of them are looking at different asset classes within real estate. So they might be big on multifamily traditionally, but now they're looking at RV parks or self-storage or flex industrial, et cetera, et cetera. Other folks are looking at completely different asset classes like getting into crypto or, this sort of thing. What you were talking a little bit off camera. What are you guys looking at pivoting into, or what have you started doing already in addition to real estate?
So we as a company, as 2023, if you don't remember, 24, there was just nothing. It was just, tumbleweeds across the entire industry. We had to look at ourselves at what do we want to do? And you saw a lot of the immersion of debt funds, particularly short-term hard money lending. A lot of multifamily operators started operating that because it had good, consistent upfront cash flow, which is what a lot of people, you could get equity level returns at debt in a debt product. Right. So there was that. We thought about that. We thought about starting a pref fund. We looked at other asset classes. And lo and behold, an old business friend of ours came, we actually co-wrote this book behind us, 10,000 Miles to the American Dream. One of the guys, the co-authors in that book, another Aussie, moved back to the US, and he approached us and said, "Hey, look, I'm really bullish on buying CPA firms." And I said, "Oh, interesting. We've been looking to do something else with more
accounting firms.
Accounting firms. Yep, yeah. Accounting firms, financial service firms. We'll just call it financial services. And we've been looking for a more cash flow heavy vehicle. The debts of the world and the prefs of the world." And lo and behold, as you started digging, we started looking at the ratio of profits to income. We thought, wow, this is quite attractive. Then you start to think, well, hang on. We then get to see the CPA is the epicenter of relationships, right? In the financial world, they are the keys to the gate, to the gates, and this could be a good, with all legal caveats applied. A good cross-sell with RSN and our multifamily side. And that meant we're not just a one-trick pony of, well, when there's a good deal, we can sell it. We can have another thing to sell. And it's interesting, Dave, like I remember talking to a family office one time, And, 10, 12, 15 years ago, when there was still a lot of fragmentation in the multifamily space, it was, hey, I'm not being offered this investment class. 10 years down the line, not to be sexist or rude or whatever, but I'm not the only girl in the bar. You know what I mean? Like, I'm not the only person offering that service. Technology's completely changed the way we do multifamily. We rent apartments. I can see within a click of a button what a studio, what a 1-bedroom, what a 2-bedroom within a 1 mile. Like, I can get very, very precise, and then with AI, I can build myself, P&L. So the barriers to entry have come down a lot. And lo and behold, when I start offering a different, not the chicken, but I'm offering the fish at the smorgasbord, all of a sudden people have money, and you're like, oh. You just over-allocated in real estate. Okay, this is great. For an M&A roll-up, maybe there's some money here. So it got me more invigorated to understand what I've learned from multi, that the widget of housing, that's my widget, and just shifting into a different widget, which is M&A, and it's different in itself, and we can talk about the risks and all that sort of stuff. But with multi, with a 100-unit building, the market will tell me what I can rent that for. With a business, I'm really dictated and looking at revenue per employee. And that's a different value add, using the same acronyms, that you can look at, and efficiencies. And there's a lot of just so inefficient businesses out there right now, but they're highly profitable. And they've got decade-long relationships with investors. And that's the key there. And we believe that is what we can grow a financial services, including advisory work, with the right licenses in place to cross-sell our multifamily stuff in due course.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. So if I'm understanding you, and I'll just feed back, just make sure I got it. You're going after accounting firms because the business model itself makes sense. There's a lot of older ones that are run very inefficiently. There's an opportunity there to go in, buy these operational, already profitable businesses, optimize them, make them more efficient. That's one side of it. That's great in and of itself.
Correct.
But then the bonus is their clientele, the people that use those CPA services, tend to be successful business owners, high income, high net worth professionals, people who need something more than TurboTax to do their taxes.
Correct.
And
they're sticky, right? They're sticky clients.
Yeah, I know. I've been with my accountant for 20 years, for crying out loud. So, that you get instant access and credibility, a built-in multi-decade sometime relationship with these clients. So once you figure out the nuance and the way to do it, it could be a really good source of investors for real estate deals. So kind of a circular thing. Am I getting the gist of it properly there? Oh, you froze up on me.
Nope.
Am I getting the gist of that properly?
Yeah, spot on, nailed.
Now, it's a whole new kettle of fish running CPA firms versus real estate deals. What about that whole? Is that what your friend brings into to the table there? Has he got operational experience?
Yeah, good question. And the biggest, the hardest part of, we've looked at a lot of firms, and it's like buying a 12-unit complex, right? 12 units is fantastic, but it's not big enough to have a full-time property manager. Yeah. And you go and buy 100, 150. So we're looking at certain size firms, so there's an EBITDA firms that have not only just the founders or the partners, but there's a second layer, and that that the partners aren't trying to exit. They're exiting, or one of them's trying to exit, but there's a lot of people out there who just don't have any succession plans. And that's where we step in and say, look, we need you to stick around. We need you to roll over some of your money into the AFG platform, accounting, we're calling it. Plus, there's a lot more creative financing. You've got a seller carry note. You've got a little bit of bank debt, but bank debt doesn't get very high in terms of leverage because it's non-real estate. And so you've got to get a bit creative. And these sellers are now on the hook, and they're still their own little entity that is still operating, and we're sort of sitting above them like the asset manager, adding the tweaks to the systemizing the ITs and adding, always be hiring and all this sort of the new talent that come through and optimizing operations. That's where we come in from a managerial perspective.
Nice. I love that idea. That's really cool. One thing that comes to mind, not to be a wet blanket, but playing devil's advocate, with the advent and the rapid ascension of AI these days, I'm just looking at what it can do, and it's still early days, but I almost think bookkeepers, accountants, their day-to-day functions, those days might be numbered with AI being able to do some pretty amazing stuff. Do you have any concerns about that?
Very good. Very good. We answer this question a lot. It's always going to make you more efficient. It's a tool in your business to be more efficient. And I don't, to your point before, I think where AI is going to be the most disruptive is around the turbo tax, that W-2, $100,000 to $150,000 once a year. You see that client. We aren't focused on acquiring firms with a large percentage of W-2 work. Right. We are focused on firms with more percentage of business work, where the cross-sell with advisory, estate planning, bookkeeping, that type of stuff, because they're having multi-million-dollar revenues in their own businesses. And to your exact point, you got a 20-year experience with your own CPA. They're very sticky. So yes, I think it's disruptive. Sure, everything's going to be disruptive, but it's not going to change the industry tomorrow. And I think, given the fact that these CPAs are so blind to technology already, just doing the basics. And for us, as more of an exit strategy, we internally need to focus on AI within the roll up when we go buy 10, 12 of these firms, to the back end being AI driven to attract the right PE buyer on the back end. That's our focus. But the individual firms aren't as focused on it, because the number one thing we find is we're too busy to even focus on technology. It's that's what we're here for.
Nice. So, I like it. I love it. Have you purchased anything? Any of these? Nice. Yep.
We're on two.
How long have you had them for?
6 months. The fund has just launched for retail investing. We've used all our own GP money to buy the first two, because it's like a sexy new motorcycle. We want to. It looks good. We want to get it started. We want to get it going, before we start selling it to the LP investors. So we're currently we've just launched the fund right now. It's a $10 to $15 million fund. It's going to be open for the next 12 to 18 months. And we're looking to buy between 10 to 15 firms, roughly at a 2 to 3 EBITDA. So below a threshold where private equity just doesn't even play because it's too small. So, yeah.
Very, very cool. Reed, this has been fascinating. Thanks for kind of opening up the book and showing us what you've been going through and how you've pivoted and what you're doing differently. If people want to connect with you and find out more, where should they go? What should they do?
You can still head over to our real estate investing side, which is rsnpropertygroup.com, or you can hit me up. It's Reed, REED, at rsnpropertygroup.com. If you're ever coming through Los Angeles, you want to meet up for a beer, talk shop, anything in the entrepreneurial space, I'm an open book. I'm pretty down to earth, and I'll tell a spade a spade. Just hit me up, shoot me an email when you're coming into town, and we'll link up.
And I can tell you from lots of past experience, having a beer or two with an Aussie tends to be a lot of fun.
Don't give it away. Don't give the secrets away.
All right, everybody. Thanks for tuning in. Reed, thanks for being on the show, and we'll see everybody on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.